The latest move by the Federal Reserve has affirmed that tackling inflation is the number 1 priority for the Federal Reserve, even if it means bringing the US into what's referred to as a hard landing. Now, a hard landing is when growth is hindered so badly by rising interest rates that the economy comes to a sudden and abrupt halt as debt repayments increase, mortgage payments rise, property valuations sink, and stocks slide rapidly lower. And the recent surge high in the dollar, which you can see here in the purple line, is due to aggressive Fed policy and general risk-off sentiment, which just has been boosting the dollar all this year. Now, one commodity that's touted as a stagflation hedge is gold, which you can see here in the golden line. But the surge in real yields in the dollar has been causing gold to fall lower. If you look back to 2020, what you'll see, and it's a general relationship that stands true for gold, is that when the dollar and real yields rise, gold falls. Conversely, when you see the dollar and real yields falling, like here, December 2020, you see gold rising. Also in the summer of June 2020, you can see the dollar, the real yields falling, and gold surging higher. We are now in a scenario where the dollar and real yields are surging higher on aggressive Fed policy, which is pushing gold lower. That's why many people have been long and wrong on gold, and they've just been fighting these headwinds of the dollar and real yields. Now, have you ever considered using seasonals to help time your entry? Because gold can be very attractive still, and we may yet still see much higher prices up to $2,000 this year. Now, what do we need to see? Well, obviously, we need to see the dollar and real yields falling. But also notice the seasonal pattern, that if we see the dollar and real yields falling in line with gold's strong seasonal pattern, that could be a huge help with a potential trade in gold. Now, just look over the last 25 years. You can see that seasonally, from sort of the end of September through to December, it's a very mixed pattern for gold with roughly, a very small annualized return. Gains and losses are equivalent. However, just take a look at the seasonal pattern in gold from December, let's just say the 24th, through to, let's just say, February, the end of February. And you can see, look, gold has significant gains over that period, gaining 20 times and only losing value 5 times over the last 25 years during this period. So, using seasonals can be a huge help to potentially time any gold entries, major trade risks. Obviously, if the US dollar and real yields stay firm, then gold can still continue to track lower despite its seasonal pattern. Remember, don't just trade it, season exit.